If you're one of the 68 million Americans receiving Social Security or SSI, listen closely because what I'm about to share could mean the difference between getting your full payment on time or missing out on money you're entitled to. This Monday, critical changes are hitting your benefits, and if you don't know the exact dates your payment is arriving or how much you should be receiving, you could be leaving hundreds of dollars on the table. The Social Security Administration just confirmed the February 2026 payment schedule, and with the new COLA increase now in effect, there are specific dates you need to circle on your calendar right now. Whether you're receiving retirement benefits, disability payments, or SSI, the next few minutes could help you avoid costly mistakes that thousands of seniors make every single month. Let's start with the biggest change that's already affecting your checks. Back in January 2026, the Social Security Administration implemented a 2.8% cost of living adjustment, and this is the increase that's now showing up in your monthly payments. According to the official SSA announcement, this COLA was calculated based on the Consumer Price Index and is designed to help your benefits keep pace with inflation. For the average retired worker, this translates to approximately a $56 monthly increase. Now, I know that might not sound like a fortune, but over the course of a year, that's $672 in additional income. For many seniors living on fixed incomes, that difference can mean affording necessary medications, covering rising utility bills, or simply having a little breathing room in your budget. But here's what you need to understand about how this COLA actually works, because there's a lot of confusion out there. The 2.8% increase applies to your base Social Security benefit, which means if you were receiving $2,000 per month before the adjustment, you're now receiving approximately $2,056. However, and this is crucial, your actual deposit amount might look different because of Medicare Part B premiums. The standard Medicare Part B premium for 2026 is deducted automatically from most Social Security checks. And while the COLA is meant to cover inflation, Medicare premiums also tend to rise. According to the Centers for Medicare and Medicaid Services, many beneficiaries saw their Medicare premiums increase as well, which means some of that COLA gets absorbed by healthcare costs. This doesn't mean you're losing money. It just means the net increase in your actual check might be smaller than the gross COLA percentage suggests. Now let's talk about SSI, because if you're receiving supplemental security income, your numbers look different. For 2026, the maximum federal SSI payment is $994 for an individual and $1,491 for a couple. These amounts also receive the 2.8% COLA boost. But SSI has very specific eligibility requirements that differ from regular Social Security. To qualify for SSI, you must be 65 or older, blind, or disabled, and you must meet strict income and resource limits. The resource limit for an individual is $2,000 and $3,000 for a couple. Resources include things like bank accounts, stocks, and bonds, but don't include your primary home or one vehicle. The income limits are more complex because SSI uses something called countable income, which excludes the first $20 of most income and the first $65 of earnings, plus 1/2 of earnings over $65. If you're working part-time and receiving SSI, this matters tremendously for calculating your actual benefit amount. Let me give you some real-world examples of how this COLA increase affects actual seniors, because understanding your own situation is key to financial planning. Let's say you're a single retired worker named Margaret, and you are receiving $1,800 per month in Social Security before the COLA. With the 2.8% increase, your new gross benefit is $1,850.40. However, the standard Medicare Part B premium of approximately $185 is deducted from your check, leaving you with a net deposit of around $1,665. Before the COLA, after the Medicare deduction, you were getting approximately $1,615, so your actual increase in take-home money is about $50 per month. Now, Margaret also has a small IRA that she withdraws $500 from each month to supplement her income. That IRA withdrawal doesn't affect her Social Security payment at all, because Social Security retirement benefits aren't reduced by other retirement income like pensions, IRAs, or 401k distributions. This is a huge misconception that I hear constantly. Here's another example. Let's say you're a married couple, John and Susan, and you're both receiving Social Security. John gets $2,100 per month, and Susan receives $1,400 based on her own work record. With the 2.8% COLA, John's benefit increases to $2,158.80, and Susan's increases to $1,439.20, for a combined household increase of about $98 before Medicare deductions. If they're both paying Medicare Part B premiums, that's roughly $370 being deducted from their combined benefits, but they're still seeing a net increase in their household Social Security income. Now, if John also has a pension from a private employer that pays $1,200 per month, that pension doesn't reduce his Social Security benefit because the pension isn't from a government job that didn't pay into Social Security. However, if Susan worked for a state government and receives a pension from a job where she didn't pay Social Security taxes, she might be affected by the government pension offset or windfall elimination provision, which are complex rules that can reduce Social Security benefits for people with certain government pensions. Now let's talk about an SSI example, because the rules are completely different. A 68-year-old receiving SSI, because he has limited work history and very little income. He receives the maximum individual SSI payment of $994 per month. Robert also receives a small Social Security benefit of $300 per month based on the few years he did work. Here's how this works. Social Security counts as unearned income for SSI purposes, but SSI excludes the first $20 of unearned income each month. So out of Robert's $300 Social Security check, only $280 counts against his SSI. SSI then reduces his payment dollar for dollar by that countable income. So Robert's SSI payment would actually be $994 minus $280, which equals $714. His total monthly income from both programs is $1,014. This is why understanding how different benefits interact is so important, because if Robert didn't know about the $20 exclusion, he might think he's being shortchanged. Let me address some of the biggest misconceptions and questions I see in the comments every single time we talk about Social Security, because clearing up confusion can save you real money. First question, does everyone get the same COLA? No. The COLA is a percentage increase applied to your individual benefit amount. So someone receiving $1,000 gets a $28 increase with a 2.8% COLA, while someone receiving $3,000 gets an $84 increase. The percentage is the same, but the dollar amount varies based on your benefit. Second question, do Medicare premiums reduce my COLA increase? Technically, yes and no. The COLA increases your gross Social Security benefit, but Medicare Part B premiums are deducted before you receive your payment. There's actually a hold harmless provision that protects most beneficiaries from having their net Social Security payment reduced if Medicare premiums increase more than the COLA, but this doesn't apply to everyone, particularly high-income beneficiaries or people new to Medicare. Third question, will my Social Security be taxed? This depends entirely on your total income. If you're single and your combined income, which is your adjusted gross income plus non-taxable interest plus half of your Social Security benefits, is between $25,000 and $34,000, up to 50% of your benefits may be taxable. If it's over $34,000, up to 85% may be taxable. For married couples filing jointly, those thresholds are $32,000 and $44,000. Notice I said up to 50% or 85% may be taxable, not that you pay 50% or 85% in taxes. What this means is that a portion of your Social Security benefit is added to your taxable income, and then you pay your regular income tax rate on that combined income. Many seniors with modest retirement income pay little to no federal tax on their Social Security because they stay below these thresholds. Fourth question, can I work while receiving Social Security? Yes, but there are rules depending on your age. If you've reached your full retirement age, which is 67 for people born in 1960 or later, you can earn as much as you want without any reduction in benefits. However, if you're receiving benefits before your full retirement age, there's an earnings limit. For 2026, if you're under full retirement age for the entire year, Social Security deducts $1 from your benefit for every $2 you earn above $23,400. In the year you reach full retirement age, The limit is higher and the deduction is $1 for every $3 you earn above $62,160. And this only applies to months before you reach full retirement age. Once you hit full retirement age, these earnings limits disappear completely. For SSI, the rules are different because SSI is a needs-based program. So any earnings reduce your SSI payment using the formula I mentioned earlier. Let's talk about resource limits for SSI, because this trips up a lot of people who might otherwise qualify. Remember, the limit is $2,000 for an individual and $3,000 for a couple. These are countable resources, which don't include your home, one vehicle, household goods, personal effects, or life insurance policies with a combined face value of $1,500 or less. Many people assume that if they have $2,500 in the bank, they're automatically disqualified. But if $1,000 of that is from a tax refund received in the past 12 months, it might be excluded, or if you can demonstrate that you're saving for an approved plan to achieve self-support, those funds might not count. The rules are complex, and if you're close to these limits, it's worth speaking with a Social Security representative or benefits counselor who can help you understand what counts and what doesn't. Another critical point about the COLA and Social Security: your COLA increase is permanent. It's not a one-time bonus. It's a raise to your base benefit that stays with you for as long as you receive benefits, and it becomes the new baseline for future COLA calculations. So if you're receiving $2,000 this year and get a 2.8% increase to $2,056, next year's COLA will be calculated on that $2,056 amount, not on the original $2,000. This compounding effect is one reason why delaying Social Security until age 70 can be so powerful if you can afford to wait. Every COLA you receive before claiming benefits doesn't help you, but every COLA after you start receiving benefits builds on a potentially larger base if you delayed. Let me share some critical tax planning information, because February is when you should be thinking about your taxes if you haven't filed yet. If you received Social Security benefits in 2025, you should have received or will soon receive Form SSA 1099, which shows the total benefits you received during the year. You need this form to complete your tax return. If you didn't receive it or lost it, you can get a replacement instantly by logging into your My Social Security account and downloading it. Don't wait until April to discover you don't have this form. For SSI recipients, SSI payments are not taxable, so you won't receive a 1099 for SSI. But if you receive both Social Security and SSI, you'll get a 1099 only for the Social Security portion. The bottom line is this: Social Security and SSI are complex programs with rules that can significantly impact your monthly income. The February 2026 payments reflect the new COLA increase that took effect in January, and knowing your exact payment date, understanding how much you should receive, and monitoring your account can help you catch problems early and maximize your benefits. Whether you're receiving retirement benefits, disability benefits, or SSI, these programs are designed to provide a foundation of income security, but they work best when you understand the rules and stay informed about changes. Don't leave money on the table because you didn't know about a benefit you're eligible for, or because you didn't notice a processing error. Check your payment this month, verify the COLA increase is reflected, and if something doesn't look right, contact Social Security immediately. Your financial security in retirement depends not just on the benefits you receive, but on your knowledge of how the system works and your willingness to advocate for yourself when necessary. Mark your calendar for your February payment date. And if you found this information helpful, make sure you're staying informed about future updates, because Social Security rules and payment schedules can change, and being prepared is the best way to protect your financial future.